Morning, Peter Rose, Longwood Currency Trading. It is a brutally cold and windy day in New England today. It's 2nd of March, and when I'm recording this, 2021, we've got probably 40-mile-an-hour winds, consistent 40-mile-an-hour winds, and some really big gusts. And the temperature is down to 8 below 0 Fahrenheit. It was down to 20 below last night. And just to give you an idea of the wind and stuff, here's a little clip that I just took of the wind howling in the trees. I hope you can hear it. So I'm having a coffee, as I always do. I'm going to put it down. I'm inside today recording, not outside. There are two main methodologies of trading Forex. You're either a long-term trader or you're a day trader. The shorter term folks on the swings, we're going to put them more into the long-term camp, and because you just keep things simple. Now, if you've watched any of my videos, then you get a very slanted view of fundamental analysis, technical analysis, everything, because I'm a day trader and I'm looking at things from a day trader standpoint. Because of my technical background and my experience in trading, because I've been a real estate investor for 40 years and I've been studying the currency market since 2007, and been trading, actively since later than that, 2018 or so. Because before that, it was an academic exercise for me. I was just interested in trading. But what I learned through all of that, particularly as a real estate investor, is that you really do have to take fundamental conditions under high consideration in your real estate purchasing. You can't just pick a property that's around a bunch of open land and say, oh, this is going to be a great place to raise the kids because, in 2 years, if you didn't pay attention, that land around you might be zoned commercial and you may have a Walmart supercenter, a parking lot next door to you in a few years. So, there are things that you need to do. If I'm just going to cut the grass over there as a short-term thing, I don't need to care whether there's a Walmart superstore going to go in there or not, because I'm buying the land for something totally different. Maybe I'm buying it to sell it to Walmart. It doesn't make any sense as a short-term vision to worry about the longer-term ramifications. You have to be aware of what's going on. I mean, you're not going to want to go to some foreign country and purchase a piece of real estate if they're about to go into a civil war or something. You're not going to want to purchase a piece of property without knowing that there's been severe landslides over the last 5 years and that some of the houses or foundations are in danger of getting washed away. I'm going to stand over here next to the wood stove because it's really nice and warm. But the conditions of your trading have to factor in the things the way that they are and the way they could be based on your time horizon. But predominant to that, and I've said this in another video, if you are not interested in macroeconomics, this is a currency trading, if you're not interested in macroeconomics or are a believer in technical analysis or any of that stuff, then you shouldn't be a long-term trader. If your personality just doesn't match what's necessary, the study that's necessary to understand the ramifications of interest rate correlations between countries and all that other stuff, then you can't play in that arena. You can't play in that game. You know, when I was a real estate investor, I didn't play in the commercial real estate market. I didn't know anything about that. And that's really a whole different ball game than buying 4-unit apartment buildings or single family houses. So, and my personality wasn't geared for that type of stuff. And my personality isn't geared to deal with the mentality of the people that are commercial real estate people. So I did what I was good at, what fit my personality. Now, when I started currency trading, I was doing it like all the books and all the educational resources tell you to do. It's all based on being a long-term trader. Risk-reward analysis is all based on long-term trading. When you're doing day trading, the whole concept of risk-reward analysis is stupid. It doesn't make any sense. It doesn't even factor into your trading. Your win-to-loss ratio is inordinately important as a day trader. Not so important when you're a long trader. So, you know, you have to take the people whose videos that you're watching and make sure you understand who they are and where they're coming from before you start adopting their advice into what you might be able to do. Now, I think that the shorter term principles are directly mappable up into the long term. I don't believe that the long term principles are mappable down into the short term. And this is where I found I'm having a hard time doing that, because all of the trading that I did before, all the simulation work, everything that I've looked at since 2007 has been based on what I'm reading about and in the books and looking at in the videos. And that's all that's out there. There's very little out there about day trading other than the stupid ass shysters that are out there claiming you make $1 million in day trading, and you know you can flip your accounts and you can do all this kind of. It's all just horseshit. It's just horseshit. There are no serious people. There are very few. I mean, I know a couple that are very reputable. My friend Langers, the scruffy trader, is from the UK. He's a day trader, but he's serious about it. He's got everything planned out, and it suits his personality. And he also does some long-term trading. But everybody else out there has no clue as to what they're doing as far as being a day trader. They don't, because they came from a long-term view. They learned all their stuff on the long-term view, and they lost all their money on the long-term view. You know, if you're trading out on the long-term view and you've got a 50 pip stop and a 50 pip profit target, or you've got a 100 pip profit target and you've got a 100 pip risk that you're assuming, and you get that wrong 6 times in a row, you're out of the game. And so it's just through brute force and luck that some of these folks are able to get successful, and then they think that they've got it all wrapped up and they really understand trading. Well, look at the difference in what skills a person needs to be a long-term real estate investor as opposed to what you have to know when you're a flipper. You watch the HGTV shows and you see the difference in the long-term real estate shows versus the guys that are out there flipping their houses, and the skill sets the difference in the skill sets that they have to have. It's the timing that creates the problem. How much time do you have to make a decision? How much time do you have to watch a scenario unfold to determine whether you're correct in your view or you're incorrect in your view? You have to balance all this stuff before you start trying to duplicate what someone else is trying to show you. So in any event, I come out of the real estate market. I did all my study in currencies on this long-term trading basis, and I got involved in it. I was really successful in the simulated markets because it's a game. It doesn't matter. You can always reload that $50,000 account 19 times until you get it, and you know, you keep reloading that account. Eventually, one time you're going to get it. I was able to to do 15% a month in long stretches, 4 or 5 months in a row at 15%. And then I'd reload the account and try to do it again, trying to replicate that. So I was doing it many, many, many times. A couple of times I'd fail and I'd wipe the account up. But I just attributed that to statistical stuff, not the fact that I was didn't really understand the trading. You have to get out into the real trading in order to determine whether your rules are going to work or not the fact that you're trading in a simulated account at maybe a couple of orders of magnitude greater in funds than you would have if you were to go in a live account. So you have to be careful about that. If you are interested in fundamentals, as I am, if you're interested in the technical analysis, as I am, please use them in their appropriate methodology within the context of the time frames that you're trying to trade on. If you're a short-term trader, you can still look at fundamental analysis, look at the macroeconomics that are out there, but you can't use that in your trading. The only macro fundamental thing that you can look at if you're a day trader is to look up onto the daily chart and see what's happened on average over the last 200 days and say, well, you know, we're in this uptrend and so we should continue in that uptrend, and the economies are going along pretty good, nobody's about to declare war, and you know, so that the pair price is going up. And so when you're down on the lower time frame as a day trader, certainly you can fade the main direction of the trend, but you have to be really, really skillful, and you have to be really, really careful. Fading the long-term direction is a great trading strategy, but not for a beginner. So you have to watch out in a lot of these books that you look at that are based primarily on long-term methodologies, long-term processes, and trying to apply that to the bank that you're going to be trading with live, which might be $1,000 or $3,000 account or a $5,000 account trading 5 minis, and looking at taking a 50 pip risk because you're trading long-term and you're trying to shoot for 50 pip profit targets. If you don't really have any experience in trading live, then you won't really understand that price is not going to go from your, no matter how good of a wind is just banging against the house, no matter how good of a trade entry person you are, going from where you are at your entry point to your 50-point potential profit target, it isn't going to go straight up there. Oh, it might. I mean, I was in a trade the other day where in under a minute the price went up 70 pips, and in the corresponding minute after that, the price came down. Up there's the bow dog, and here's my wife coming in. I'll go in where it's quiet, and the price went down something like 37 pips in probably 30 seconds, and so you can't really balance what's going to happen if you're trading with a short stack and looking at a 50 pip risk, because what happens if that gets taken out 4 or 5 times in a row? You're going to run out of money. So there are ways that you need to learn how to mitigate that if you're learning on the longer time frames. It's totally different when you're down on the day trading time frames. I'm not going to get into those mechanics in this video. This is an awareness video for you, just to be aware of that, to go back over the body of my video works that you can be exposed to in some of my blog posts, and try to see how I'm progressing along with making that transition from the longer term time frames and the longer term thinking down into the shorter time frames. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.